Today's topic is financial empowerment. Money talks, but are you listening? This is a keynote that will decode the telltale signals of stocks, property, and crypto so you can build lasting wealth. Guiding us today are Jeremy Britton, founder of the world's first crypto mutual fund, and Jennifer Robertson, the Boston Trading CEO, committed to making digital investing safe, smart, and inclusive. Jeremy and Jennifer, the stage is yours.
Thank you. Can we hear? Can everyone say hi? In Australia, where we are, it's now Thursday morning. I think other people might be on Wednesday afternoon. You just drop in the chat where you are so we can say hi. And I'll even show you a puppy, you know, just to get the excitement going. So, and there's going to be some prizes for the interactivity. So I'm going to talk about a little book here. You can see the book. And we've also got some nice swag featuring the puppy heads and things like that. So depending on what you're into, sent some prizes this afternoon off to Germany and sent some prizes the other day off to the UK. So if I can work the technology, and Jenny, you can jump in anytime and say whether it's working or not. We want to find out how to make as much money in as short time as possible. So tell me please if that's working.
That is working and you're full screen.
Excellent, excellent, excellent. So, all right. The clicker isn't working. I'm sorry, Robin.
No worries.
Technical difficulties that
Yeah,
inevitably come.
That's a part of life.
All right.
There we go.
Have we got one? All right. So that's the little picture of the puppy. Money. What's money? Anybody want to just drop in the chat? What does money mean to you? What's possible with money? What can you do with it? Way of getting more of what you want. Way of buying more toys. All good. What we want to do is have enough money so that you can do the things that you want to do with the people that you want to be with for as long as you want to. Popular investments that you would have heard of: property, stocks and shares, and cryptocurrency. Property we've known since the Stone Age, perhaps how long we lived in properties, been buying and selling properties. Stocks and shares have been around for about 400 years. Crypto's only been around for the last 15 years. So a relatively new asset class, but obviously making big waves, making big changes in technology, particularly in medical records, science, insurance, and the stock market as well. So the important question is when to buy. Most people have probably heard the phrase, you know, if you buy property, you can double your money in 5 to 10 years. If you buy stocks and shares, you can double your money in 5 to 10 years. Not so sure about crypto, but it's really when you buy is the important part. Okay. This is US figures, so I apologize for those of us who are outside the US, but they just happen to have the most common figures available. The returns in property over the last 50 years have averaged between 4 to 7%. Returns in the stock market have averaged 10 to 15% over the last 50 years. Obviously, twice, you know, almost twice the returns in the stock market, but cryptocurrency returns have averaged 30 to 150%, but significantly more volatility. And you can hear the puppies in the background. Great. Everybody please grab their phones very quickly. Put your phone on your desk. This is going to be important. And answer the question, why is there an asterisk next to crypto? Robin, feel free to jump in and break the ice.
But we don't have to Google that, do we? You're going to give us a formula to help us out with that.
Yes. So the asterisk is there because crypto, how long has crypto been around? Help me out here, kids.
2001.
So crypto has not been around for the last 50 years. That's the asterisk. But what we're going to find out is how we can actually get some of those results by long-term analysis. So the NASDAQ, the stock exchange in the US, started off in 1980. It's been going for 45 years. During those 45 years, it doesn't trade every day because it's closed on Saturday, it's closed on Sunday, it's closed on Easter Day and Christmas Day and Thanksgiving Day and whatever other days, okay? So it's 250 trading days per year, and the stock market is open for 7 hours a day. So somebody with their calculator on their phone can please calculate for me how many trading hours has the NASDAQ had in the last 45 years. 45 by 250 by 7. I said there was going to be prizes.
78,750.
78,000 hours. Okay, thank you. Thank you. Excellent. So that's how long the NASDAQ has been up, trading hours, 78,000. All right, so let's have a look now. Cryptocurrency, which has only been around for 15 years since the global financial crisis, but it's been trading every single day, 24 hours a day. Bitcoin has never gone down, never shut down, because it's a worldwide asset. And while you're sleeping or while you're having Christmas dinner, there's someone in another country who is awake while you're asleep or asleep while you're awake. People in India and China might not be celebrating Christmas if you're celebrating Christmas. 15 years by 365 days by 24 hours. Help me out with the math here. How many hours has crypto been running?
I have the answer, but I'm going to give some space if somebody else want to join in. Or, yeah.
It's
Looking in
Miliani.
the 131,000 hours, Miliani. Thank you. So what was your answer, Robin? How long's the NASDAQ been going?
I forgot that. 78,000.
78,750.
Yeah. In 45 years, most of us haven't been alive that long. 45 years, the NASDAQ has been running only 78,000 hours. Crypto's been running 131,000 hours, almost twice as long uptime, even though it's only been around for 15 years. So that's how we can draw some lines, we can draw some analysis, because we've got the figures of what the prices were. So the Medici Bank, some of you may have heard of the Medici Bank, was founded in 1397 in Rome. The Dutch started recording their house prices, how many guilders for a house, in the 1400s. And if you've watched Johnny Depp, the Pirates of the Caribbean movie, you know the Dutch East India Company first traded in 1602. So some investors made this artificial construct of a company, put in some money, and the ship guys could actually build ships, go and trade spices and things like that and bring returns back to people. So stocks and shares have been around for 400 years. House prices have been around for 600 years. And crypto's been around longer than the stock market by a number of hours. So we can have a look at the prices, we can have a look at patterns and what prices were, how things are affected in different markets. Okay, again, grab your phone, take a picture of this. This is the slide that can literally make you millions. It can show you how to make twice as much money in half the time. There's other people out there who say, yes, you know, buying a house, you can double your money in 10 to 12 years, or you buy stocks, you can double your money in 7 to 10 years. But if you know when to buy and when to sell, you can literally do it twice as fast. So this is a slide was in the book that I showed you earlier. This is a book that I wrote 20 years ago. And the tool itself is over 300 years old, okay? Studying every economy around the world, and these things happen in the same sequence, one after another, and always have throughout history. If you know the patterns, you can recognize what's going to come next. So the reserve banks or the governments, depending on who's in charge, can only do a couple of things. They can put up interest rates or they can put them down. They can make more cash available, they can make less cash available. That's all they can do. So if house prices are getting too high, the banks will put up the interest rates to stop people from buying houses, okay? And that has a follow-on effect. As dominoes, you push one domino, the next one's going to go, the next one's going to go. So once you know this, understand what's going to happen and say, okay, this is the time to buy, this is the time to buy this asset. It's very important to know this, okay? What are you going to spend the money on, Rob?
Supporting a thriving future in general.
Lovely, lovely. Most people, when they're being recorded, they always say they're going to do something benevolent with the money. If we weren't recording this session, they're probably going to say you're going to buy a Lamborghini or something like that. But that's fine. We're going to help the world and be benevolent and save the rainforests and the penguins. And that's all good. But it's up to you, individuals, whatever you want to do. This is just a tool to show you how to make twice as much money twice as quickly. Now, it's a strategy game like chess. If you do this, the other person's going to do this, the other person's going to do this. You can teach a 10-year-old child how to play chess within a couple of hours, all right? Becoming a grandmaster is a little bit different. It might take you 10 years, but you can learn the basic skills. So my job is to teach you the basic skills, and then it's up to you whether you want to go on and be the master or whether you would just want to find out how to make twice as much money in half the time. So again, grab your phone, take a picture of this slide. That's where you get the free book. The book that I wrote in 2006, which was looking at the economic cycles and saying stock market is getting overheated. There's a couple of other indicators. There is going to be a stock market crash. Right? Now, I didn't know exactly the time and the date and the hour, but the global financial crisis happened within 2 years of me putting that book out saying there was going to be a stock market crash. If you've seen the movie with Christian Bale and a couple of other beautiful people, Michael Burry also knew there was going to be a stock market crash because he was following the indicators. He didn't tell anybody. He made a bet against the banks. He made $1 billion. I tried to warn everybody. I sold a few thousand books. And again, used the same tool to forecast the 2020 pandemic crash. So if you go onto our website, you can actually see the newsletter that we sent out in September 2019 saying, heads up, there's going to be another stock market crash. And what happens after a stock market crash is governments around the world, central banks around the world, print more cash. They print more money, they lower the interest rates, put cash in the system because they don't want to have a recession or a depression, right? So that's what's going to happen afterwards. We gave that warning September 2019, there's going to be a crash. Governments will behave predictably, printing cash, which will drive up the prices of scarce commodities. So we said in September 2019, get out of your stocks, buy gold, buy silver, buy Bitcoin, right? We didn't know there was going to be a disease outbreak, but there's always going to be a trigger event that makes the stock market correct, whether it's a plane crash or assassination or whatever it is. The trigger event occurred, the pandemic, stocks went down as we forecast they would. Gold went up 50%, silver went up 100%, Bitcoin went up 400%. That's where you should be paying attention, okay? Now grab the book. For those of us who were around during the 80s, you may remember some of these events when the stock market was getting higher. The Wall Street movie with Charlie Sheen came out in 1985. Got a lot of people interested in Wall Street and in stocks and shares for the first time. Retail people started to pile in rather than just institutional investors. And the stock market went up. In 1985, it went up 45%. When it was going up very, very high, a lot of people go, oh my God, I need to pile into the stock market. It went up another 60% the following year, okay? Remembering back to one of the first slides, we know the long running average of the stock market was only 15%. So it goes up by 40, 50, 60%. That should be an indication to you that there's going to be a crash coming because the long running average is going to hold, okay? After the 1987 crash, people pulled out of the stock market, they piled into property. Property prices doubled within 3 or 4 years, very, very short space of time. If you're in the right place at the right time, you would have made money very, very quickly. When the property prices got too unsustainable, banks reacted by putting up the interest rates. And if you weren't around at the time, ask your parents or your grandparents what it was like trying to pay off a house when the interest rates were 18%. It was incredibly difficult. And it did cause recessions in several countries. And again, governments don't like recessions. They drop the interest rates down, which causes the next domino, the next domino, the next domino. And these things move. You can look down the side there. Every 7 to 12 years, this cycle just repeats itself. And the government can only pull the levers one way or the other, which sets the next dominoes in motion. So for those who like visual charts, you can have a look at that one there. And you can see the stock market, the top line is very choppy. There is the stock market crash, 1987 crash, the famous one. And there's 2001 Twin Towers crash, 2008, which was the global financial crisis. The property ones are a bit harder to see because property is not as volatile. But I've put little red rings around. So you can see the first little red ring, early 1990s, 1992 is where the interest rates went up. And if you look very closely on that slide, you can see the property prices actually started to go down. Very slightly went down and stayed flat for 7 years. So if you bought a property at the start of 1992 and you held it through to 1999, you basically made no money whatsoever. 7 years of no growth, okay? Because the interest rates were too high and the governments kept putting down the interest rates until they could actually stimulate the economy. 7 years after the peak, that's when I bought a property in 1999, and I told a lot of my clients to buy property. Said property markets are going to take off. The stock market is overheated. And 18 months later, I had people phoning me saying, what's going on? Nothing's happened. What's going on? You're wrong. It's like, no, I wasn't wrong. I was just a bit early. I didn't know the Twin Towers were going to come down, but it was 18 months later that the stock market crashed, property market took off again. And that's when I made 260% on my property within the space of 4 years. Again, after the global financial crisis, you can see late 2000s there, property prices have dropped down. Not good time to be in property, but within a couple of years, great time to be in property. And then 2020, market correction as well. So it's not a case of you have to sell your property every 5 years and buy stocks and then sell your stocks every 5 years and buy property. You can actually be in both markets, and some people do that. Diversification, you can be in both markets at the same time, and then if the stock market crashes, you don't stress too much that the property market's gone down. You've got both assets at the same time. Click on the next slide, there we go. So you've got 3 seconds if you haven't got the book at the moment. 1, 2, 3, grab that, free gift. And just a little bit about me, middle. So 30 years, in 1992, I first got into the stock market. 10 years in crypto. I first found out about crypto in 2012, but didn't get in until 2015. And there's still people who haven't got in now. Jennifer and I did found the world's first crypto mutual fund because we wanted to make crypto investing safe and simple for people. Most people, about 85% of people, don't want to choose their own stocks or don't have time. Too busy with the work, they're too busy with the children, they're too busy with their careers and their lives and that sort of stuff. So most people will actually go to their financial advisor or their accountant and they'll choose a mutual fund where they can buy the S&P 500, they can buy the Chinese stock market, they can buy whatever the fund is and have someone look after it for you. That's what we do, but for crypto rather than for stocks and shares. Now, this colourful clock is the updated version of the black and white one, because things were in black and white in the olden days, kids, from 20 years ago. And this one includes cryptocurrency. So you can see when is a good time to buy real estate, when is a good time to buy crypto. And what some people don't realize, yes, you can get a loan to buy property, but you can also get a loan to buy stocks and shares. If you've got a decent portfolio of stocks and shares, you can actually borrow against your stocks and shares to buy property at an appropriate time. You can also borrow against the property to buy more stocks and shares or cryptocurrency when it's an appropriate time. Now, with this clock here, again, you can see when it's rising interest rates. All you got to do is pick up a newspaper and know whether the interest rates are rising or whether the interest rates are going down, whether the government is printing cash or not printing cash like they did during the pandemic. But it's even easier nowadays because you can actually use AI. You can jump onto ChatGPT and say, hey, read the news headlines from around the world. Are we in a peak cycle? Are we in a contraction cycle? Are we in low interest rates? Are we in high interest rates? I actually uploaded this clock image to ChatGPT and said, check it against your historical data, verify that's the case, and then tell me what time it is on the economic clock right now, like whether we're in a good time to buy property, whether we're in a good time to buy stocks and crypto. Has anybody got an idea just from looking at that? So one hand raised.
So for people who are looking at this for the first time, Jeremy, how would you help them understand? Well, so they're really looking at the different areas on this clock, and then looking at those outside, the things that are typically in the kind of 12 o'clock, 1 o'clock, 2 o'clock position, and then trying to position there to understand what to do with their money.
Yeah. So the quantitative easing over on the 9 o'clock side is quantitative easing is basically a code word for when the banks or the governments print cash. You know, something's gone wrong. There's been a recession. There's been a pandemic. There's been whatever, and they want to stimulate the economy. They print a lot of cash. They lower the interest rates, and that's when people start to spend more money. People start to expand their life. People start to buy more houses. And we move up into the pre-boom, the falling interest rates, which is moving into when it's a time, because obviously after that, you can see after 12 is a good time to own real estate. When the interest rates are low, more people are going to buy houses. So yeah, you're following along the outside and knowing what asset class that you want to be in next. And at the moment, so we had the quantitative easing previously, with the stimulus packages and things like that. We're now moving around to the other side, teetering on the edge of recession. And again, if you looked at the news over the last few days, you would have seen, you know, contraction in the job market and things like that, which is actually a good time to start moving into crypto and stocks and holding those for the next couple of years. I mean, you don't need to set your watch by it. It's not going to be like today's a great day and then next Thursday is when you've got to sell. These are usually like a 2 or 3 year phase. And if you're 6 months early, even if you're a year early, it doesn't matter. As I say, like I've been using this tool for many, many years to predict what's going next. 2006, I was actually 2 years ahead of time. But it didn't matter because I happened to be in the right place when things happened. And 2019 was 6 months ahead of time. But you're in the right place at the right time. You're better off getting to the party an hour early than turning up 5 minutes late and missing the juggling act or the cute puppy. So again, it's one of those things. It takes you a couple of hours to learn how to use the clock. There is a full explanation in the book, and you do get the book for free. So I'm not here to sell you books or anything like that. Go onto the website, you can get the book for free. The book's 20 years old. It's been out of print for a long time. But the advice in there is timeless because we're using a tool that's been accurate for 300 years. It's like a compass. You could buy a compass from 1876 or buy a compass from 1600. It's still going to work the same way. So hopefully that answers the question. But don't worry if you don't get it the first time. There's a whole book about it and you can read the book twice. Just some final tips, again, for safety, because you can be in the right place at the right time, or you can go hands off and just say, I'm going to be diversified. Because if you own property and shares and the stock market crashes, you're okay because the property is going to go up in value. If the property market starts to cool down, that means that your shares are about to take off. So you don't panic about that. If you don't want to move around and change your tactic every couple of years. So with property, there's obviously residential property. Most of us live in a residential property. There's commercial properties for business, industrial properties, manufacturing. There's also agricultural property. Different types of property. And you want properties in different locations. Because, you know, Robin's a multi-millionaire. He owns 3 houses in one street. But if he owns 3 houses in the street, number 10, number 12, and number 14, and then the terrorists move in across the road, all of his properties have now gone down in value. So the idea would be to have different properties in different locations. And then if the nasty neighbours move into next to this one, it's not going to affect your other one. Or if you have different types of property, then the residential market isn't going to affect the industrial market or the agricultural market. Now, if you don't have the millions and billions of dollars that Robin has to own properties in every location, in every town, every country in the world,
I wish.
you can buy you can buy what's called a REIT, Real Estate Investment Trust, and they diversify it for you. So you might put, you know, a couple of $1,000s into the fund, and the fund goes out and buys lots of different properties in different locations, gives you diversification. And the other thing is it's very easy to get in and out of those, as opposed to when you buy a house and then you try and sell it, it might take several months to sell a house. Whereas if you're in a REIT, you can just phone up and say, hey, I want to pull out my $10,000. Somebody else is actually putting in on the same day. They can sell to the other investors. It's very easy to get in and out of those things. Similar thing for stocks, different types of stocks. I'm old enough to have held airline stocks the day before 9/11. And let me tell you, after a plane crash, nobody wants to buy your airline stocks. They've all gone down. But at the same time, stocks in supermarkets and telcos went up. So you have different ones. Whether there's a war on, whether there's a pandemic on, someone is actually making money. Okay. Obviously, during the pandemic, no one was going out to the restaurants, but people were getting home delivered food. Stocks in Netflix and streaming services and home delivery services and things like that. Zoom, for example, telcos went up during the pandemic. People who were making masks and hand sanitizer, those guys made money. So you have different stocks in different industries and again, different locations, because there's not too many microchip manufacturers in Ecuador or in Switzerland. You know, most of those guys are in China or Taiwan. Different things are made in different regions. And again, if you've got a big portfolio, you can do that yourself. Otherwise, you can buy a stock index fund, or exchange traded fund, ETF, where you can just give your money to the fund manager and they'll go, okay, we're going to buy you the S&P 500, the top 500 stocks in the US. We're going to buy you the Chinese stock market. So you've got all the electronic cars and the computer chips and this sort of stuff. Spreading the eggs into different baskets so that if something happens, whether there's a war or a famine or a pandemic or a plane crash, you're not going to lose all your money. Not all of your things are going to go down at the same time. How we can do the same thing with the crypto market as well. So some of these terms may be unfamiliar if you haven't been around the crypto circles. DeFi is decentralized finance, basically the crypto equivalent of banking. DePIN is decentralized physical infrastructure. So those are like windmills, solar farms, tunnels, bridges, those sort of things. RWA is real world assets. Some people out there know that, you know, Swiss watches, old bottles of scotch, oil paintings, some of these things do increase in value when the stock market crashes. But not all of us can afford to go out and buy a Van Gogh or a Monet when the stock market's dipping. So by having the RWAs, they actually buy a share. Like someone will buy an oil painting and they'll have a crypto representing, 1/1000th of that. So 1,000 people can all chip in together and buy these real world assets and sell them just as easily as you can sell stocks and shares or the REITs.
So it's like tokenization, essentially, of a real world asset.
Yeah. You're buying a token that represents ownership of something in the same way that people, rather than buying physical gold coins, you can buy paper gold. You can buy basically stocks in a piece of gold. So it's a similar thing. It's all on the blockchain. It's all there. It's transparent for everybody to see at all time. Now, the crypto infrastructure is kind of like the rails that things run on. They used to have the old saying, if there's a gold rush on in your town, you want to be selling picks and shovels. Okay, so all of the cryptocurrencies, they run on the phone lines. They run on the fiber optics. You have to go to a crypto exchange to buy or sell the cryptocurrencies. So if Bitcoin was superseded tomorrow with XYZ coin, a lot of people are going to go to the exchanges, they're going to sell their Bitcoin, and they're going to buy the XYZ coin. The exchanges are making money whether the market's going up or down. So these are things that you want to invest into. And again, you've got the option of either doing it yourself or you can go to the index funds. They do it for you, white glove service, diversified. So Galaxy actually invests into the parent companies. So they might invest in the companies that actually make the tokens. And with Boston Trading, we invest in the tokens themselves, which are more liquid, easier to trade, but also more volatile. That's the tips. Learn the clockwork investing. You've got the tools, sit there and study it for a while, or read the book if you're into that. Diversify the old eggs in different baskets, because you don't want to have all your money in airline stocks the day before a plane crash. You don't want to have all your money in property when the interest rates have just hit 13%. Diversify your holdings, diversify your diversification, and talk to an expert. Excuse me. There's plenty of people who'll say, oh, my friend Bill, he made 35% in the stock market last year. You should talk to Bill. Or little Timmy down the road bought Trump coin and made 7,000%, or Pepe coin or Melania coin and made $1 million. That's true, maybe. Some people sometimes just get lucky, and sometimes it's dumb luck from being in the right place at the right time. And you want to talk to someone who's actually knows what they're doing, didn't just get lucky, but someone who's been doing it for 10, 20, 30 years and has got multiple runs on the board. So with our Boston fund, we've actually made gains more than 10,000% 7 times in the last 10 years, because we know how to do the research, we know how to pick good stocks, we know how to pick good cryptocurrencies. In actual fact, we've just done the month end for the end of July. And for the end of July, the best performing assets have actually been stocks in the crypto fund. We made 600% on a crypto exchange, and we made over 300% on one of the telcos, one of the fiber optic suppliers. So it's interesting where you can actually make money from the picks and shovels plays rather than those. Excuse me. I'm starting to get a sore throat. It's that time of the night. It's past midnight where I am, and I've been talking since 6 o'clock this morning. So I'll be quiet, and hopefully there's some questions that people are going to ask Jennifer.
Well, are there any questions?
I'm just looking through the chat because I've been paying attention to the slides. Okay. Robin, Sydney. Okay. Can't see your video, Sydney. That's all right. Maybe it's just too much information.
Yeah, it doesn't look like there's any questions, unless someone wanted you to go through the economic clock again or talk about where we're at in the particular cycle.
Yes. I'm thinking we're down in the bottom third at the moment. That's my opinion. I'm not responsible for all of your money. But again, it's important to learn it in the same way as I use the example of when I was 18 or 19, I bought a car manual for my car because I wanted to know how to change my own oil. I wanted to know how to change my own spark plugs, partially because I didn't have the money to take my car to the mechanic. And when I was a uni student, I had plenty of time. I could sit out in the backyard and I could, tinker with the engine on my car and save myself the trip to the mechanic and save myself a lot of money. I had plenty of time. I didn't have much cash. That's what I did. Fast forward 10 years later, when I was in my 30s and I had 3 children, I had a mortgage and I had a career, I didn't have the time to work on my own car, but I had the money to pay the mechanic. But I could pay the mechanic to do the job and trust the mechanic to do the job because I knew what the mechanic was supposed to be doing. So even if you don't have time to manage your own portfolio, it's always good practice to know what the experts should be doing. So you can make sure no one's going to rip you off. No one's going to be doing the wrong thing. You're not going to be trusting someone with your money when that person isn't even as smart as you. So you need to understand how the system works, even if you're going to trust it to somebody else and let them do it for you.
I think as well, when we're looking at that that last piece of the puzzle about talk to the experts, a number of people today won't necessarily pick up the phone. They'll be looking at YouTube, they'll be looking at other people. So I think from my perspective, it's probably, you don't necessarily have to talk to an expert, but if you're listening to someone on a YouTube channel, just dig around a bit and just see how long they've been in the market, because it's very easy when the market's going up to be an expert. My suggestion would be to find someone who does potentially have a little grey hair or does have a bit of longevity in the financial markets in particular, because they would have seen the bull and the bear markets. They would have had to then live through those things and understand that things don't go swimmingly well all the time, and then the pivots necessary to be able to give you some good advice around that.
Yeah, that's a good point. I mean, when we're doing research into, and before we invest in stocks, we have a look at who's actually running the show. The founder of the company, we look them up on LinkedIn. They can fake a profile on Facebook. Anybody can do that. On LinkedIn and Twitter, there is some sort of verification process. And if they've been in business for a while, you can actually see, look, this person who's putting farmland on the blockchain, you can research into them and say, what did they used to do? What was their experience? Have they had experience in the agricultural industry before they came to blockchain? Have they had experience in doing similar projects, similar businesses? Have they failed in business before I actually put my money with them? I want to know what they've done. And similar thing, as you say, on YouTube, there's a lot of people, particularly when it's a great crypto market as it is right now. Things are very exciting. And 4 years ago, it was a great crypto market as well. And there was a lot of people who came out of the woodwork like, oh, I'm the crypto expert, because they got lucky one time, or just because they're actually pretending and they're scamming people. But if you look into their history and you track that person and say, what were they doing 3 years ago? Were they selling multi-level marketing, or were they working for somebody else, or whatever? Make sure the person's actually got a bit of experience and does know what they're doing. That's very important.
Yeah, I think because a lot of a lot of hindsight can be very useful, particularly in video. So I've seen a number, and it's not to disparage anyone, but people say, oh, you know, if you bought in at this time and you put $1,000 in that particular day on that particular coin, then this is where you'd be at now. But the question is, you know, you can't do that with every coin. There's plenty of dead coins out there. There's plenty of meme coins out there that, you know, personally, you know, we probably wouldn't touch with a barge pole when it comes to meme coins because they don't actually have any utility. And so I think it's also being very mindful about how people pitch their expertise as well, because I think it's really easy to say, well, if you bought Ripple right at the very outset, then you'd be, you know, up goodness knows how many tens of 1,000%. It really is, well, you know, did they buy, and if so, how much? And what are, you know, what are the losses that have gone to, or what are the coins that have gone to zero? Because the unfortunate thing about this particular industry, particularly when it comes to crypto, is that not everyone wants to tell you the things that they bet on but didn't win. So you know, one of the great questions you could ask of anyone who's particularly in the crypto market is, so you know, that's a great looking investment, you know, Ripple or Solana, you know, sort of right at the very beginning, but how many coins did that, you know, did you invest in that went to zero? Because that then means that, because, you know, you can't, as I said, you can't scattergun when it comes to some of the diversification. And so crypto being a newer market, I think that's the one that, again, we have a particular interest in because we're trying to make it safer, more secure and more transparent.
Yeah. There's some things you can only learn by making mistakes or having a few grey hairs, as you say. And I mean, even in the stock market where I cut my teeth, there were people who say, oh, you know, if you had invested $10 in Apple computers back in 1977, or if you put $13 into Microsoft back in 1983, and like, yeah, great, but nobody did. And also, if you have a look at the pictures of Bill Gates, or if you have a look at the pictures of Steve Jobs back in the 70s and 80s, would you have given them money? I mean, they looked like drug lords back then, you know, with the long hair and that sort of stuff. But there's also thousands, you know, for every Microsoft, for every Amazon, for every Apple, there's thousands and thousands of companies that went broke. And, you know, during the late 90s, early 2000s, if you'd put money into Yahoo or Google or something like that, you could have put in $10,000 and literally made over $1 million. But there was thousands and thousands of other companies that just disappeared, were scams, went bankrupt. So it's important to have a look at the founders, have a look at what they're doing, and diversify and talk to an expert. Absolutely, because you can lose a lot more than what you can win. Everybody wishes they had bought those stocks back in those days. Everybody wishes they'd bought Bitcoin when it was $1, but most of us didn't. And now you're sort of saying, okay, what's going to be the next one? I don't know. You don't know. Someone's going to do the research, and we'll find out together.
I might have a question. It's a very open question. Sometimes, so investing has been on my horizon throughout my life, but I've never really pursued it. And sometimes I don't even know what the question to ask would be. So my question to you is, what's a question you wished you asked yourself, or just asked in general 15 years ago on your beginning of your journey? And what would the answer be? It's a very open question.
Ladies first.
That's a great question, Robin. You know, I remember my dad always telling me, you've got to save a bit of money. You know, you spend money because, you know, I was working my way through high school and uni and all these sorts of other things. And he would tell me, you spend money like you've got a hole in your pocket, you know, you're burning a hole in your pocket. And of course, you know, being young, I thought my dad knew absolutely nothing. Meanwhile, he was a chartered accountant, but let's not go there. So maybe I should have listened. And so I think it's that idea of trying to save a little bit and then figure out how to start early in some things. Because, and particularly now when I think about it, because at the time when I was younger, my younger self, it was costly to invest in shares, you know, kind of as an individual. You usually had to go through a broker, there were usually the brokerage fees and those sorts of things. So starting out with a little bit of money you would still find that that administration and brokerage cost would eat into it. So it was a bit of a disincentive. I think now, if I were, kind of my younger self thinking about investing now, there's the barriers to entry are so low. I mean, meanwhile, of course, the barriers, there's fewer barriers for scams and those sorts of things to be out there, but the barriers to participate financially in the financial system, whether it be through crypto or other things, is much lower, and kind of through DeFi and other things like that. I think that, kind of just starting, just make the start, just make the commitment, forego just a cup of coffee, every couple of days or something like that, because if it's that kind of whole very, it's very boring advice from a very old person, Robin, saying that, the journey starts with, the first step. And so sometimes just kind of getting into the discipline and the habit of, kind of just looking at, where would you put your money if you had it? Because the way that you treat those small amounts of money is probably going to be the way that you treat the larger amounts of money as well.
Thank you.
Nice.
What about you, Jeremy?
I'm a little bit older than Jennifer. I can remember literally ringing up the broker, and it cost $80 for the broker to place the trade for you. And you had to buy, some shares you had to buy a minimum of $500 worth. Some shares you had to buy a minimum of $1,000 worth, depending on what the shares were. But as Jennifer said, nowadays the brokerage, like on Robinhood and some of these discount online brokers, there's no fee. And you can literally buy $5 worth of a stock. And on some of these things, you can buy half a stock or a quarter of a stock. And with cryptocurrencies, you can buy, 1/1,000,000th of a Bitcoin. So the barriers to entry are now so low that 10-year-old kids can buy cryptocurrency and stocks. And I'm very jealous. If you're a 10-year-old kid watching, I'm very jealous of you, because you can get started for lower amounts. And that's something I wish I had started earlier. Warren Buffett bought his first stock when he was 11 years old. He said he wished he'd started earlier. So I was 19. I wish I'd started earlier. And you just allow that compounding effect, good quality things over time. Because even people say, oh yeah, I wish I bought Amazon back in the day, but have a look at what happened with the Amazon stock and how long it took. And there was a few little ups and downs along the way. In the tech 2001, Apple stock dropped by 60%, Microsoft stock 80%. People don't tell you that, right? It wasn't smooth sailing the entire time. And there's some times where you wish you'd gotten rid of it, but allowing that time to bounce back and allowing 10 or 20 years of compound growth is really good. One thing I wish I had learned a lot younger is remembering to take the profits. So I used to pat myself on the back when I'd spend an afternoon researching the heck out of a stock. I'd buy it for $1, and then 6 months later it would go to $10. And I go, oh my God, I'm amazing. I've just made 10 times my money. But then 6 months later it would crash down to $4. And I go, damn, should have sold when it was 10. But you never know when the peak's going to be. But you do know when you've actually made money. So you can say, now I take some profit along the way. And the talk I gave this morning, I was talking about picking apples. The tree's grown from $1 to $10, you might sell off half. And then you go, okay, look, I've made 5 times my money. I've got that cash, and I can put that cash into something else, diversify into other things, use that for property or for other stocks or whatever, and then leave the other $5 there. And if that goes up, down, or sideways, even if it goes to zero, it doesn't matter, because you've already taken that profit. And I didn't do when I was younger. And I literally bought stocks for 5 cents that went up to like $1.95 and go, oh my God, I'm amazing. I've made 20 times my money. And then the next year the company went bankrupt. So learning to take little wins along the way and diversify. I've learned the hard way. I've learned over a 33-year career, and I'm still getting better, and I'm still learning. And crypto is one of those things where there's new out every single day. There's always something exciting going on. There's always something to learn. And the fun part is, though, that even with new tech, you can use a 300-year-old tool to predict what's coming down the pipeline. So there's a bit of reassurance in that.
Thank you. Maybe any last questions from you, May, Muliani, or Sydney? This is your chance.
No, all
No?
silent. All right.
Any last thoughts or you want to share before we round it off?
See you at Davos in January.
Yeah.
Otherwise, we do travel around a bit. I'm actually in Bali this week for CoinFest, cryptocurrency convention. I know Jennifer's going to be in the US. We were in Dubai a couple of months ago for financial technology and a cryptocurrency convention over there. So anybody with a little puppy, this way, puppy, come say hi. That's the Davos one. That's the one from Davos. So yeah, we're not from America. It says Boston. It's a Boston Terrier. So come and talk to us about puppies, even if you don't want to talk about crypto. We are quite friendly.
Nice. Any last words, Jenny?
Oh, no, you feel free to reach out and connect if you want some more information.
Cool. Jeremy and Jenny, thank you so much for guiding us, onboarding us into the very first step of lifelong journey, I understand. For me, I realize I have a lot of homework to do now. So thank you so much for the clockwork and all the new concepts. And with that, we'll see each other in Davos 2026, I guess. So until then,
Fantastic.
have a nice ride. Of
Thanks, Robin. Thanks for being
Thank
a great
you.
host.
course. I'll just stop the recording.